Problem 1635, statement of cash flows, this time including a calculation of free cash flow. So the comparative balance sheet of Morstan Educational Supply at the end of the year was as follows. And then their transactions included this data. So our job is to create a statement of cash flows. And as usual, we're going to start off with operating activities. And again, once again, as a review, the operating activities are going to have net income, depreciation, back out gains and losses. We're going to analyze changes in current assets and changes in current liabilities. So let's start with getting this out of the way. Oh, we actually need that. So we need that for our net income, $59,600. And then on our cheat sheet, we said the first thing is we're going to add depreciation. Depreciation is here. We need to add it because we're backing out depreciation since it is actually a non-cash flow item. And this is, after all, the statement of cash flows. So we have $17,000. I'm getting that from here. $17,000 of depreciation. And then we need gains and losses per our guide. We're going to back out our gains and losses. So does this company have any gains or losses? I don't see any gains or losses, so we will skip those. In the real world, you would look for the gain or loss on the income statement. They did not give us a full income statement. So what is next on our guide? We need to analyze changes in current assets and then changes in current liabilities. So here are our current assets. The first one is AR. So it looks like AR decreased by $6,700. So if AR decreased, what would cause our AR to decrease? Our customers must have paid us off. And so if our customers are paying us off, we have to add that change. Let me move this out of the way. So we have a decrease in AR. That means our cash went up by $6,700. Remember, this is the change was $6,700. That's where the change comes from. Next, we have our inventory. And of course, back up a second. We're just using this rule here. If current assets decrease, then we have to add to cash. And then we've got inventory. Inventory is increasing. So what would cause inventory to increase? We must have purchased inventory. And what happens to cash if we purchase inventory? Our cash must have gone down. So it looks like the difference is $3,600, and since cash went down, since we purchased inventory, we have to subtract that. Increase in merchandise inventory. And again, that's just following this rule. If there's an increase in a current asset, we have to subtract. Now we're going to analyze AP. So it looks like AP increased by $1,000. And the rule is if a current liability increases, you're going to add that difference. So we're going to add $1,000 for an increase in AP. And the last thing we have to analyze is our accrued liabilities. These are liabilities that have accumulated but not yet been paid. The most common example is wages payable or salaries payable. So if salaries payable decreased, that means we must have paid off our liabilities. And if we pay off our liabilities, cash must have gone down. So we are going to subtract the difference of $500. Decrease in accrued liabilities. And that is just following this rule right here. Decrease in current liabilities, you subtract. So we're done analyzing our current assets and current liabilities. So what we need to do is sum these. And when you do that, you get positive 20,600. And since these are two positive numbers, you're going to add those up to get $80,200 of cash provided by operating activities. Now we are in the investing section. What goes in the investing section? As a reminder, changes to long-term assets. You can also see that over here. Changes to long-term assets go in the investing section. So let's open up our box again and look for long-term assets. Starting over here on the left side, payment of cash dividends, that affects equity. Purchase of equipment with cash. So equipment is a long-term asset, so that's going to go in this section. And since we purchased it, this 55,100 is the amount of cash we spent, so it has to be a negative number. Minus 55,100. Acquisition of equipment. Next thing on the list is an issuance of long-term note payable. That is a liability, so that does not go in the investing section. Issuance of common stock, that's equity. That goes in the finance section. Depreciation expense, we've already done right here in the operating section. And here we go, purchase of building. A building is a long-term asset, and we use cash. So we have minus 102,000 since we spent the cash. Acquisition of a building. And then the only other thing we got is net income, which we've already used up at the top right here. So, and that obviously does not go in the investing section. So our next task is to sum these. So we're going to get minus $157,100. So this is net cash used for investing activities. I say used because it's a negative number. We spent that cash on equipment and building. Now, we are in the financing section. What goes in the financing section? Right here, the financing section is changes to long-term liabilities and changes to equity. Also summarized right here. So we need our box again. And we're just going to go through this list and look for changes to long-term liabilities and owner's equity. So the first one we got is payment of cash dividends. Cash dividends will eventually come out of retained earnings, which is an equity account at the end of the period when cash dividends are closed to retained earnings. So we need to include that payment of cash dividends, cash payment of dividends, and since we're paying cash as a negative number, minus 20,200. Next thing on the list, equipment, that goes in investing. Issuance of a long-term note payable to borrow cash. So long-term note payable is a long-term liability, goes in the financing section. So cash receipt from issuing a note payable. And since we're getting the cash, this is going to be a positive number. And how much cash do we get? $47,000. Next thing on our list is issuance of common stock for cash. Common stock is an equity account, so that goes in the financing section. So cash receipt from issuing common stock. Since we received cash, that's a positive number. And then all these others have been used. None of them are long-term liabilities or owner's equity. So now we need to sum these up and put the total right here. And when you sum those up, you should get a positive 140,800. So we have cash provided by operating activity since this is a positive number. And what's our main source of cash? It is issuing stock. Now we need to calculate the net increase or decrease in cash. So one way to do that is to sum these three sections. Add these numbers up, and we get a positive 63,900. Now, a double check of that number is back here in this data table where we have our cash beginning balance and our ending balance. So what's the difference between 21,500 and 85,400? It is 63,900. So that checks out. Now, they want us to put in our beginning cash amount, so 21,500 goes here. And then our ending cash amount, 85,400, goes there. Check answer. Good job. So now they're gonna ask us questions about our cash flow. We need to evaluate Worston's cash flows. So operations, are operations generating or using up? So in other words, is this operating number positive or negative? So this is good news. We got positive cash flow. So our operations are generating cash flow. And then how about plant assets? Is the company investing, in other words, purchasing new plant assets, or is it divesting itself? Divesting means to get rid of. So if you go back up here to our investing section, we have minus cash flow. Why? Because we are purchasing equipment and building. So we are investing in new plant assets. And then how about our source of financing? So here's our financing section. You scroll down a little bit. There's more financing from borrowing or issuing stock. Well, here's the borrowing, 47,000. Here's issuing stock, 114,000. So there's more financing by issuing stock than by borrowing. And did cash increase or decrease? Well, right here we know it increased. Here's our positive increase. And you know that by the beginning balance and the ending balance of cash. And for these reasons, does their cash flow look good or bad? It looks strong. Now we're going to calculate free cash flow. So here's the requirement. If Morston plans similar activity for 2017, the next year, what is its expected free cash flow? So use a minus sign or parentheses for a negative free cash flow. Here's some abbreviations. NCOA is net cash provided by operating activities, and NCFA is net cash provided by financing activities. So if you remember, the formula is net cash from operating activities minus cash payments for planned investments minus cash dividends. And notice they say if Morston plans similar activity for 2017. So what was their operating activities? Cash flow. Net cash from operating activities, 80,200. And we're going to assume their investments are going to be the same for the next year. So their investments was 157,100. 157,100. And their dividends, they're going to continue to pay those dividends, was 20,200. 20,200. So the formula is you take your net cash from operating activities, subtract your investments in plant assets, and subtract your cash dividend payments. When we do the math, we get minus 97,100. So this company has a negative free cash flow. So what this means is if they're going to have the same cash flow from operating activities, they cannot continue to invest this much into planned investments while also carrying that type of a dividend payment. Something's going to have to give in the long run. Now, what they could do is they could borrow. I mean, they could still have negative free cash flow in the future, but they could make up for it by borrowing or issuing stock. But you can't issue stock forever, and you cannot borrow forever. So this company has a negative free cash flow. And that's it.